Hello, everyone. I'm Matt Clark, research analyst for Money and Markets, and joining me as he does each and every week from an underground bunker in South America is Green Zone Fortunes coder Charles Sizemore. It is time for another episode of Investing with Charles. Today, we are going to talk about dividend yield. But before I get into that, I do want to remind everyone that if you do have a comment or a question, something you'd like Charles to answer, feel free to do so. You can email us. The email address is feedback@moneyandmarkets.com. We'll flash that right down below, or you can comment below on our YouTube channel. If we do use one of your questions in an upcoming video, we're going to hook you up with some very, very cool Money and Markets gear. We've got t-shirts, we've got hats, all sorts of stuff. Just send us a question either through YouTube or email, and we will hook you up. Now, Charles, today our question comes from John, and he's got a very interesting question. I think is right in the wheelhouse. He says, should I be concerned if a stock's dividend payment as a percentage is about half what it was a few months after I bought the stock? So basically he's asking if the dividend percentage, the percentage yield has been cut since he bought the stock, is that a sign of concern?
Yes and no. It is a complex question. So what he's asking about is the dividend yield. The dividend yield is the current dividend divided by the stock price expressed as a percentage. So if that dividend yield goes from, let's just say 5% to 2.5%, that can happen one of two ways. It can happen because the numerator changed or because the denominator changed. So if it happens because the stock price has shot higher, that denominator, then that's really not anything to be concerned about. It's something to be happy about. It means your stock price went up a lot, and now that yield is lower as a result. You may want to take profits. There's nothing wrong with taking profits, of course. If you feel the stock has now gotten ahead of itself, it may not be as attractive as it was when you bought it. But is it a cause for concern? Absolutely not. It would be a cause for celebration. Now, the other potentiality there is if it's the numerator, if the yield got cut in half because the dividend got cut in half. For one, it would be rare for the yield to be cut in half, because what normally happens is if a stock cuts its dividend, usually the price also falls. So the dividend ends up kind of basically being, the yield ends up being unchanged. It's just everything becomes lower. So in this case, if companies slash their dividend from whatever, $5 a share to $2.50 a share, generally speaking, the stock price is going to fall proportionately or even more to where that yield, like that as a percentage, kind of remains unchanged. But as to the question of should you be concerned, actually, yeah. So when companies cut their dividends, that is something that should concern you. It doesn't necessarily mean the stock's going to zero, but it does mean that the stock is under stress. When the dividend is really the last thing management ever wants to cut. And the reason is it sends such a damaging message to shareholders. When shareholders see management cutting the dividend, they're like, okay, I'm out. Management's lost, they've lost their way, they've lost faith. I'm going to cut my loss here, sell the stock, and, move on to greener pastures. So, and there is some justification for that. When a company is growing and healthy and has cash coming in, they can afford to maintain that dividend or raise it. When they're cutting that dividend, it's because things are not good. The cash isn't coming in to support it. Something has fundamentally changed, or the company's in trouble. And while there can be some value opportunities in there potentially, as a general rule, this is a stock you're wanting to keep for income. Do you want to own something that's cutting its payout? Probably not. You want to own something that's maintaining or ideally raising its payout over time. That's where you get that margin of safety. So kind of to summarize, if the dividend yield falls, it could be for two reasons. Either the dividend was cut or the stock price rose. If the stock price rose, you're golden. That's great. That's what we all want. That's why we do this, right? If it's because the dividend fell, you may want to look into selling the stock.
Does the opposite work? Does the opposite work if things are reversed? If the dividend is maybe increased, is that does that reverse the play a little bit?
Well, yeah. So continuing that, if the dividend yield rises, that can happen one of two ways. If the stock price is unchanged and the dividend yield rises, that means that the payout increased. It means the company raised their dividend. Well, that's great. That's what we want to see, particularly during a time of inflation. You want current income, but you want that income to rise over time. So that's really a positive when you see the dividend yield rise because of it. When you see the yield rise because of a rise in the dollar amount of the dividend, that's good. That's a sign of health, and it's an unambiguous positive. Now, when you see that yield rise because the price fell, that could be good or it could be bad. If you look at the company, it looks healthy. You've done your homework. It looks like the dividend at its current rate is sustainable. And what I mean by that is, let's say that dividend is, again, let's just say that dividend is $2.50, but the company is producing, $3, $4, $5 in earnings, then they have more than enough cash coming in to support that dividend. It's fine. You have nothing to worry about. If that yield goes higher, it's a buying opportunity. Fantastic. If that dividend looks like it may not be sustainable, sometimes when a dividend yield gets really high, like abnormally high, it's probably not sustainable. The market's telegraphing that a dividend cut is likely. So in this case, let's say again, that dividend's $2.50, but the company is only producing $1 in earnings. How long are they going to be able to pay out $2.50 if they're only making $1? Well, not very long. That dividend's very likely to be cut. So if you see an exceptionally high dividend, and depending on the stock, depending on the industry, what qualifies as exceptionally high can vary. In some cases, 4% might be exceptionally high. In other cases, it might be 10, 12, 20, whatever. But if you do see an abnormally high dividend based on if a company's yield is abnormally high based on its own history or based on its peers, that may be a sign that the dividend's about to get cut.
And that's going to lead into what we're going to talk about next week. And we're going to dive a little deeper into dividend growth. So, John, great question. Really appreciate that. Again, the question was, should he be concerned if a stock's dividend payment as a percentage is half or lower in some form or fashion than what it was a few months after he bought the stock? And the answer basically is that it really just kind of depends on why the stock was lowered in the first place. If the stock price has gone higher, then no, not necessarily a cause of concern, because you're going to see benefits on the stock price. If it was just cut for the sake of cutting and the stock price has not moved forward, then that might be a bit of a flag for you to take a look at your position and decide maybe there's some changes that you need to make at that point in time. Charles, good job wrapping through that. Again, next week, we're going to talk about dividend growth. And if you do have a question about dividend growth or dividends in general, anything of that nature, you can email us and send those questions along to us. Feedback@moneyandmarkets.com is the email address. We'll put that right down below. You can also comment here on our YouTube channel. We'd love to see any questions that you have. If you do send us a question and we do use it like we did with John's, we're going to send you some free Money in Markets gear, hats, t-shirts, sweatshirts, all sorts of great stuff. We're going to send that out to you once we use your question. Charles, any other parting shots related to dividend payments, dividend yields?
No, just as a general rule, there's this idea that a higher dividend yield is always better. And sure, I mean, who doesn't want to make more? If you go to the bank and they offer you a 5% CD, that sounds a lot better than a 1% CD, right? Not that those yields are realistic in this environment, but just humor me. Obviously, all else equal, you want a higher yield, right? Well, with stocks and their dividends, all else is not equal. There's always a lot more moving parts there. So when you do see a high dividend yield, you do need to do a little bit more homework, figure out why the yield is high and if it's sustainable. And that ties in very nicely to what we'll discuss next week.
Very good. He is Charles Sizemore. He is hiding out in a bunker in South America. I'm kidding. He's actually not. I know exactly where he is, but I just like to tease him just because it's winter there and it's probably a little colder, as you can see by his jacket. So until next time, he is Charles Sizemore. He is the co-editor of Green Zone Fortunes. I'm Matt Clark, research analyst for Money in Markets. Until next time, everyone, safe trading.